Sir, if you could hear us, kindly try with the Twitter app. And okay, you are here.
Prince, now I think you should get it.
Yeah, loud and clear, sir. Very well. Good evening and welcome. Sir, if you could hear us, kindly try with the Twitter app. And okay, you are here.
Prince, now I think you should get it.
Yeah, I also had the laptop on, so I have disabled that. So hopefully you're not getting the feedback that you might have
You
been
might have
getting
been
earlier.
getting early. Yeah, it is better now, sir.
So, very warm welcome, sir. So, guys, let me take a moment to introduce our guest for today. Today, we have Rajeev Agrawal, sir, with us. He's a CFA, and by education, he's a BTech graduate from IIT Bombay and MBA from IIM Calcutta. And he's currently a fund manager and managing partner at Doordarshi India Fund. So basically, the fund is based out of the US, but they are investing in Indian equities. That we would be knowing down the line in the session. So, Sir has over more than 15 plus years of experience in Indian and US markets and maybe more. He's a strong proponent of value investing and believes in India equity market because it is full of opportunities and that also matches the investing style of Rajiv sir. So previously also he had been with very great organizations in the past in the role of technology executive focusing on the financial industry, XIHS market, Goldman Sachs, Bank of America, JP Morgan, etc. So very warm welcome, sir. If I missed on to anything, you can surely add to the intro thing. But again, let me throw a question straight away. So how it all started for you, especially the market journey, and being in the, you had a MBA background. So how does that help you in your initial phase of investing and all? Yeah, over to you, sir.
Thank you, Prince, for that warm introduction and warm welcome. Very excited actually to do the Twitter Spaces. So, as a disclosure, first Twitter Spaces, as you could see, it took us some time to get set up, but very excited to do this and excited to have all the participants. So, to answer your question, actually, the journey for investing, or my investing journey really started when I was in the middle school, and it is very interesting because my grandfather and my uncle used to invest. In those days, very few people were investing, but my grandfather was interested, and the way they used to invest was by reading newspapers and seeing what IPOs are coming. And I always found it fascinating that they are able to read newspapers and invest in these companies. And so I said, this is really interesting. So when I went to IIT Bombay for my bachelor's, I said, now I have got a line where I can sort of do all right. And let me now go back to another area which is of interest to me, which is investing. And for those of you who may remember, at that point, and this is 1991, is when I went to IIT Bombay. So at that point, there was a big boom that was going on in the stock market. And so I borrowed some money from my father and started investing in the IPO market, right? And you know what happened in 1992. So pretty much in the next few years, whatever I invested, the paper that I got, because at that point you used to get the stock certificates, the paper was not even worth, anything, right? So everything was down the drain. It was zero. And I said, well, I cannot really do investing. So, once you start from that very bad experience, then the good news is that only thing is you can only go up. But for the next 10 years, I was completely out of the stock market. I said, I don't understand it and I don't want to lose any more money. But in early 2000s, I came to know about Warren Buffett and Charlie Munger. And that is when my fascination with investing and value investing especially really started. And since most of you would know, Agrawal means Banya, and Banya understand value investing very well. You always want to pay less than what it is worth. And so as soon I heard about value investing, I said, this is it. This is what I want to do, right? And then over time, as you read more and more about Charlie Munger and Warren Buffett, you realize that what they say is not just true about investing, but it is true about life. So I always tell people that, value investing is just not just a way to invest, but it is a way to actually live one's life. And one of the ways of doing that is by bringing the right people in your ecosystem and so on. So rather than just going through the whole story, basically, at that point, once I figured out what I wanted to do, it was then a matter of saying, how can I move from a corporate world, which I was in and I continued to be in till 2016, and then get onto a stage where I was financially independent and therefore able to invest for myself and then over time for others as well.
Great, great. So in those times, like the engineering and MBA things are very rare. And if we talk about the prestigious institutions, then again, it is again very, very rare. So you got an opportunity of, doing MBA in those times. But don't you think like that helped you understand the things initially? Because you talked about the losses in the IPOs, and when you burnt your hands initially, you left out of the market for over a decade. You just told. So don't you think like MBA is? If we talk about even in today's scenario, MBA education is sufficient so as to guide one about the market education.
So actually, I now currently sometimes go and give lectures in some of the preeminent institutions, MBA institutions around investing. And what is very interesting, if you look at the MBA curriculum, it gives you a good background around accounting, right? And around how a business works and so on. But what I think is equally important for people to realize is that a lot of investing knowledge that is given in these curriculums is still based on efficient market theory, right? And as a value investor, you know that efficient market theory only exists in theory, not in practice, right? And for us to make money, what we really have to do is to find companies that are mispriced. And efficient market theory says companies can never be mispriced, right? Depending on what form you are taking. So, going back to your question of whether MBA education is useful, I definitely think it is, right? Because you need to understand the language of the business, which is accounting. So you need to get that, and that you can get through many different ways. You need to understand how or why a business succeeds, and therefore business strategy becomes important, right? You need to be able to understand the competitive landscape of where the business exists in. And again, all those things are very helpful. Similarly, you need to be able to understand the capital markets, right? The ability to raise money, what are the various ways of capital allocation. So I think MBA is a very good start. But one should also keep in mind that some of the things that are taught in the MBA curriculum, you actually have to learn. So it's not just a question of learning, it is also a question of unlearning as you go through your MBA curriculum and decide what makes sense to you and what doesn't. So I think the short answer is yes, MBA definitely helps, but it is also important to know its limitations.
Right. See, sir, we often get into a debate value investing still relevant because people these days are proponent of growth investing, or is it like people don't understand the true value of value investing in the sense?
Yeah, so actually, this dichotomy that exists between growth investing and value investing, I think is in my mind at least a mistake, because as Buffett has said, which is that all growth investing is also part of value investing. Because ultimately, what is investing, right? Investing is all about buying something which you think is worth a lot more than what you are paying for, right? And whether it is growth or it is value, the ultimate point is that it should be worth a lot more than what you're paying for. And that could be because the company grows a lot, the business grows a lot, and through that, it creates value. Or it could be that the company is not currently valued, or just based on the current financials, you may realize that the company should be worth a lot more than what you're paying for. But the fact is that all investing requires you to pay a lot less than what it is worth. And that could be through growth, or it could be through the current the current financials and the current business. And either way, I think that to me is investing. And when we invest in our fund, Dudarshi India Fund, one of the very important things we tell people is that though we practice value investing, the fact is that growth is a very significant part of value. And when we are looking at Indian markets, clearly Indian markets are growth markets, right? And so we are not in the business of buying at a point 0.5 price to book or something like that. What we are in the business of is finding good companies that we think can deliver us good returns over time. It will be a combination of growth. It could be a combination of the current valuations at which we are buying them, but both are very very important for us to realize the value that we think is inherent in those businesses. And so we don't think that growth investing is anything different, but a component of value investing, and that is how we think of it.
Right, great. So, sir, like if we talk about the process and framework which you follow, and what are the screening criterias which you think like help you identifying a good company, maybe a growth company, right? And I mean, see, what is the starting point from where we get those ideas and all? If you would like to talk about.
Sure. So I think in terms of ideas and how they come to us, I think one of the very important things is the willingness to keep looking, right? And those could be just reading newspapers. And many of us would have seen these very prominent investors read a lot of newspapers. So newspapers could be just a starting point. It could be because you've researched some company in the past and you can look at their competitors, or you understand the new adjacencies that are coming in. So for example, if I am investing in, let's say, financials, and in financials, there are various categories. Especially if I talk about NBFCs, for example, so there is a microfinance institution, there is a gold loan companies, right? There is vehicle finance companies. So there's those specializations that one could. And if you are in one particular segment, it may not be that difficult for you to be able to find other segments in that space, which requires some understanding of the underlying collateral. But still, it is very similar in the sense that you understand what are the key requirements, be it the capital adequacy ratio, be it the quality of assets, be it the net interest margin, the cost to income ratio, things like that, right? So I think what happens is whenever you are investing, you first need to understand the business. If you don't understand the business, at least the way we think is that if we don't understand how a business works, why it makes money, it is not an opportunity for us. It may be an opportunity for other people, but it is not an opportunity for us. So, knowing and being very reasonable about what is something which you can understand, what is it something that you're trying to understand but you don't feel you understand well, is very important. And so you keep looking at ideas, you spend some time on it, and then you say, okay, is it something that I can understand? Why it makes money? Is it cheap or not? And a lot of people, where they go wrong with investing is they invest because their friends invest, or they invest because somebody gives them a hot tip. And what I tell them is that tips are okay for investing, but what will you do if it goes up 20%? Will you sell it or will you keep it, and why? And most people don't understand that. So it is very important for people to realize why they're investing, because especially when things go down, will they be able to be invested in it? And so our ideas come from newspapers, from talking to friends, from looking at what companies we have and the companies in that ecosystem, but also other competitors in that ecosystem. It could be because we either are presenting at different conferences and other smart investors are presenting at those conferences. So there are many, many different ways. Sometimes we're just walking around somewhere and we see, okay, a particular company has a board and we might want to say, okay, what does that company do, right? So, or even, for example, you're watching television and you might get some ad, and that could be another trigger because you might like the ad or you might just want to know about the companies. So one of the things I say about finding ideas is to be very curious about what is happening around you, and therefore what are the companies in our ecosystem that we are seeing, and then seeing if those companies can we understand, and do we think those companies are the companies that we want to participate in.
Correct. So, sir, would you like to? I mean, of course, we are not talking stock specific, but any case study which you want to discuss of the past, which you identified telling about these all these data points you just discussed?
Sure. I mean, I think, see, what I do and what I would recommend many of the listeners on this Twitter space is to actually go and look at our website, which is www.doordarshiadvisors.com. And we have quite a few case studies on our website. And maybe I can pick one or two and give some flavor of how we think. But if you want to really do a deep dive on how we think, you should go to our website. And what we do really there is, from time to time, we present our ideas on different forums. And by presenting our ideas on different forums, we at least are able to lay out how we think something will happen and then watch how that presents itself over time, right? So I actually recently presented. Now, this is not investment advice, and I would encourage everybody to do their own work because one of the things, as I was saying earlier, is that nobody really should be investing based on hot tips because tips are likely to go against you, right? I mean, as it happened to me early on in my career, I think investing becomes most dangerous when you don't have any conviction on what you are doing. But recently, in one of the conferences, I had presented on an idea which is Ujjivan, a small finance bank, and that is a simple example of what I think, how we think about our process, how we think about the companies. Once again, what I'm going to say, you people should not take it at face value. Because Ujjivan Small Finance Bank or its holding company, Ujjivan Financial Services Limited, is something that we hold in our portfolio in the fund and in the personal capacity. So clearly we are biased, right? And we don't want anybody to think otherwise. So we will tell you that please do your own work and please don't rely on anything that we are about to say now. But let's come back to the small finance bank as a space, right? And the small finance bank was set up around 5, 6 years back by RBI, or it enabled companies to become small finance bank around 5, 6 years back because in India, as we all know, credit is highly underpenetrated. There is not enough credit available. There are huge spectrum of people who are in the bottom, right, bottom of the pyramid, and if they just have some credit available, they can dramatically improve their lifestyle, right? You would know, many of us would know that especially in rural areas, some of these customers borrow at very, very high rates. So RBI has been looking at how they can enable people to borrow and improve their livelihood because, if you can borrow money, let's say, get a cow or a buffalo or whatever, you can start generating a significant amount of income just from that simple activity, right? I mean, it does require a lot of work, but having that initial credit, buying something or setting up a shop suddenly can dramatically improve your income. So RBI has been working on that, and they set up a separate category called microfinance institutions, MFIs, right? And this whole business concept was set up in Bangladesh initially as Grameen Bank, and then it propagated to the world over. And Indian regulators also adopted it in early 2010s, or actually in early 2000s, I should call it, when Ujjivan and Equitas and others came into existence. And they were really more to enable that the bottom of the pyramid people can borrow and therefore improve their livelihood. And then over time, the MFIs were successful in deploying credit to the most needy. But also, this model was quite successful. And the reason it was successful was because the people who were borrowing, first of all, they were borrowing in an uncollateralized manner, as in they did not have any collateral to give. And so everybody thought this is going to be a very risky segment. But at least the experience till 2015 was that it was not such a risky segment because you are typically giving loans not to one individual, but to a group. And that is where the whole concept of joint lending group came in, right? Or self-help group, which are the two main ways that the MFIs were giving out loans. And the problem that these institutions then had was that while they were giving out loans, they did not have any good way of raising the money for giving out loans, which is the liabilities that they will have on the balance sheet. And therefore, these MFIs were always dependent on banks and other institutions to give them money so that they can further lend out to the very needy. And so this created a problem where banks sometimes were in the same business as these MFIs, and therefore they found it hard to compete with the banks. And so RBI in 2015 came up with this regulation which said that we can set up small finance bank where 75% of the loans have to be given in the rural areas. And so that is when this whole SFB, the Small Finance Bank, came into existence. And some of the MFIs were able to convert from MFIs to Small Finance Bank, and Ujjivan was one of them. And then, of course, we have had demonetization, we have had COVID and other stuff. So clearly, a lot of these institutions have suffered mightily in the last, let's say, 5-6 years because the economy had not done well and these companies had not done well as well. Because as I said, these are uncollateralized loan, and therefore, if economy suffers, then the customers suffer, and then these institutions suffer because they don't get the loans that they've given out. They don't get those loans back, and therefore the asset quality deteriorates. So Ujjivan, after doing very well for the first decade of its existence till 2015, has sort of suffered quite a lot in the last few years. Let's call it 5 to 7 years, right? And that is when the bank came into existence. So bank came into existence by converting the entire loan book of Ujjivan into Ujjivan Small Finance Bank. And the good news with the bank now is that they have liabilities, they have assets, they're not as dependent on the other institutions for borrowing. They have their own deposit book. And so I would say that they are a lot more resilient now than they were in the 2015 when they were doing well. And as the economy improves and heals, and the people who took on the loans improve and heal, we think that this is an area that will actually have a lot of credit demand. And that credit demand will manifest in the bank able to grow its loan book well, which will manifest in good earnings and therefore will manifest in good prices. But again, this is an illustration that I have given about the fact that if you understand the history of an institution, if you understand why the institution makes money, and then you're able to see why you think the future looks better than what it was in the past, you can have a differentiated insight.
Right, sir. So, but like when we talk about financials, the bad news are normally back-ended, right? So, would you also like to touch upon the risk you see, which should be taken into consideration also while going through such case studies? I mean,
Sure, no, absolutely. I think first thing we should always remember with almost all investing is that understanding the risk is the most important because, as Buffett has said, rule number one, don't lose money, and rule number two, don't forget rule number one. Right? So understanding the risk is really, really important. And in a case study like Ujjivan, I think the most important risk is if the economy suffers, the bank will suffer. There's just no question about it. And the reason that will happen is because if the economy is going to go down because, let's say, the macro is not looking as good or the world is not looking as good, then that could impact the livelihood of the people who have borrowed from the bank. That could be one. The second thing is that the bank may be making wrong decisions. They might be giving loans to people who are not who are likely not to repay those loans. So the underwriting of the loan book is very, very important. And so you need to have some comfort that these borrowers are good borrowers. And that really, as an investor, you cannot judge. So all you can judge is the quality of the management. And so understanding who is running the bank, how do they think, what has been their past track record is very important. Then the third element is no matter how good the economy is doing and how good the management is, the third challenge is what is the competitive intensity, right? And if there is a lot of competitive intensity, that could also create a problem because many of you would have heard that the bad money drives out good money, right? And so if there's a lot of bad underwriting that is going on in the competition, then that can cause Ujjivan to suffer. And so that is another thing one has to think about, which is what is the environment like? What are the competition doing? And therefore, what are the possibilities that Ujjivan may suffer because of that? And then the fourth, especially in financial, world is the regulations. So, is the regulatory landscape going to be hurtful to the institutions, or is it going to be helpful to the institutions that we are talking about, right? And sometimes it may not be having any material effect. So, those are some of the key risks that we should be mindful of and ensure that we are thinking of them continuously, because only if you manage your risk well are you likely to be able to succeed in investing.
Right, great, sir. So we have one speaker in between. We take his question. So Sam Vardhan, you can quickly unmute and ask your question from sir.
So, first of all, thank you, Prince, for accepting my request. I'm a great admirer of Mr. Rajeev, sir. He is the one person who improves my EQ level by giving a presentation, by sharing the thoughts by PPT on the Doordarshini India website. So, my first question is about what do you think about holding a microfinance company for long term if we escape macro and micro economic drawdown? And second question is about, can you tell story behind how you ask question to Warren Buffett in Berkshire Hathaway AGM meeting last year?
Sure. Thanks for that, Sam. So let me start with the second question first. I must say I'm very proud of having the opportunity to ask a question at Berkshire in 2022. Um, so, this time in 22, I actually went for Berkshire annual meeting with my family. So my wife and my two kids were with me, and it was wonderful that I was able to ask a question. And one of the things which I've always admired about Warren is how humble he is, right? And so the way the whole questioning thing works is that you need to give your name and you need to be lucky. And so we were lucky. So I think that is great. But I think I'm even prouder of the fact when I asked him the question. I don't know, Sam, if you realized, but he did say, "We will do is we want to give you a."
Sir, your voice is cracking. Can you
Oh,
please
I
check
see.
this?
Okay, not sure. Okay, is it better?
Yes, sir.
Yes, sir.
Oh, great. Okay. So I was saying that 2022 was one of the those favorite years where I was able to ask a question to Warren at the annual meeting of Berkshire Hathaway, and this time my family was there with me as well. So you know the one thing I've always admired about Warren is the fact that he's so humble, right? And so he will never advertise for to anybody how smart he is about market timing, and that is the question I did ask him, which is how is it that he is able to time the market so well, though he always says don't time the market. And the response I got sort of was surprising and very, very heartening. And he said, listen, first thing, we'd like to offer you a job. Not that I was looking for a job, but the fact that the Warren is offering you a job is just completely next level. So I was very, very excited about that. And so I think I'm just delighted of being in that ecosystem of people who admire Warren and go to annual Berkshire meeting, because I think I become a better person because of that. And that is one of the things that I was saying earlier, that value investing is not just about investing, it's about life and whom you interact and how you interact. And so very, very lucky to have that opportunity. Happy to answer anything additional on Berkshire, but moving to your first question about MFIs and how long you want to hold them for. I think one has to understand that markets are forward looking, right? And therefore, even before the numbers start looking bad, the markets will sort of assess that and start pricing things accordingly. So, really, the important thing is to see whether you feel that the business will continue to improve or will worsen from where it is and what is accounted for in terms of the valuations, right? And if you think that something is fully priced, one should possibly look at alternatives if you can find alternatives. But it is also important to realize that investing in anything is always a question about relative grading, right? So if I'm investing in an MFI and let's say I find another chemical company that looks even more compelling, then should I be invested in MFI fully, or should I start taking some money off the table? And my at least approach to things like this is to say that if something is fairly priced or fully priced, then I am happy to put the money into alternatives that may give me better returns. And so, really, I don't think when I invest, I have an assessment of what I think a company can do from a return perspective. But really, at that point, what I am trying to say is what are the other better alternatives that I can understand? And as long as I can find something better than what I have, I'm happy to put the next incremental dollar into that particular opportunity rather than into a MFI or anything else that I feel I was initially committed to. And so that is how I do my capital allocation, which is look at the best opportunities that I can find, which I can understand obviously, and then allocate there rather than be fixated on a particular company.
Thank you, sir.
Thank you, sir.
Prince, if you allow
Prince, if
me,
you
can I
allow me,
ask
can
one
I
more
ask one
question?
more question? Yeah, sure, please.
So he is the one person who invested in IIFL after ILNFS crisis after 2019 at the price of 170, 1117, and he is the one person who invested in Ujjivan Financial Services Company during the maximum pessimistic time after microfinance business crashes. So how do you able to develop that philosophy, buying during the maximum pessimistic time?
Thanks a lot again, Sam. I think it is more about you understanding the two things which I think are very important. One, the management. I think in financials, you cannot invest unless you can understand the management, right? So I talked a little bit about Ujjivan earlier, where I laid out how I thought about it. But basically, if you look at Ujjivan and who founded it, which is Samit Ghosh, right? And all you have to do is to put yourself in his place and see what he went through, where he came from, first of all, right? So Ujjivan was founded by Samit Ghosh. Samit Ghosh was in some of the well-known financial institutions before he started Ujjivan. And why would a person who was so successful start Ujjivan, right? Unless he really wanted to do well for the world. So you need to first understand where a management is coming from. Why is he or she doing what they are doing? And therefore how they think, right? So management is very important. But then you also, as I said, you need to think about the competitive landscape. You need to think about what sector they are in, and then take advantage of that. So once I understood that, I realized that things will go up and down, and nobody knows whether it is up from here, down from here. But over the long term, and this is where another important element, which is the time horizon has to be long term. You cannot say that just because you have invested, things should start going up. In fact, it almost never happens that way. And so the ability for me to be able to develop not only a comfort level with the management, the business, but also a comfort level with the time horizon is very important. And so at least when I thought about Ujjivan, it felt like in a few years, right? It should do all right. Now, how well it will do depends on a lot of other factors we cannot control. Similarly, going back to your IIFL Finance example, that is another area where if you just look at IIFL Finance history and the person who runs that, which is Nirmal Jain, you will realize that Nirmal has been an entrepreneur for almost 2 decades. And look at his more than 2 decades actually, and look at his track record. Look at how he built out IIFL, then he separated three companies into three companies, right? IIFL Finance, IIFL Securities, IIFL Wealth, and he has given the company and the ownership of different businesses to different people who have actually grown those businesses, and that tells you about the entrepreneurial mindset of the individual, right? It also shows that when most managements, what do they want to do? They want to have more and more power, right? They want to keep building out new businesses without distribute or without really giving up control. And when a company separates into three different companies, it tells a lot about the management. And I think at least my observation is that unless you get comfortable with the management, I at least don't want to invest in that particular company in India, because I feel in India, management has to be aligned with that of the shareholder. And so finding companies where the management is very well aligned with you is paramount. Now, developing that comfort with the management takes a lot of time. It takes a lot of understanding of what the management has done in the past and therefore how they are likely to behave in the future. And this is very, very subjective. You may think you are right, but you may be completely wrong. And so the willingness then to change one's mind once you have made a decision is as important. And many times you might find ourselves in situations where we felt good about the management, but the management really did not perform. And you give them time, you give them the leash, if you will, and see how if things change around. But if they don't, there is no reason to think that you want to make money the same way that you lost it, right? So be willing to cut your losses once you realize that the management is not behaving the way you expect them to.
Thank you
Thank
so
you so
much.
much.
So
So
actually,
actually,
I
I
also
also
invested in
invested in
uh,
uh, IFL Finance at the price of a 70 rupees when market cap is around 2,300 crore and everything is going negative. At that point, IFL making profit after tax of rupees 700 crore and their total AUM is around 23,000 crore. So what is my biggest mistake is I did not allocated maximum portion of my portfolio. So everyone is talking about diversification and all those things. Can you please suggest me about concentrating portfolio when you find such a valuable big bet?
No, that's exactly right. So one is finding the ideas. The second one is how much money you allocate to them, right? And so I think what I at least think for myself is that you should diversify when you don't have that many good opportunities, but you should concentrate when you find something really compelling, right? And at least that is how I think of allocating money. So I think you did even better by finding IFL at a very good price. But the fact that you may not have allocated as much as you wanted is something that is a regret of most investors, right? If something does well, we always want that, okay, we should have allocated even more money. And so, one of the things we should all realize is that investing is a game of regrets. You never are fully satisfied because if something does well, you wish you had allocated more. And if something goes down, you wish you had allocated less. So I think first thing to realize is that no matter what we do, we will have regrets, right? Then the second thing to realize is, or at least what I use for myself, is that if I find something really compelling and then I look at the next best opportunity I have, right? So I look at the most interesting opportunity and then look at the next opportunity. If the next opportunity is very similar in terms of my expectation, then I would diversify between those two, right? But if the next best opportunity is not as interesting as the first one, then I will concentrate in the first one. So where I allocate my capital depends on what are the opportunities I'm seeing, how many are those, how compelling are those, and therefore that is how I allocate and I concentrate or diversify based on that.
All right. So Rajeev, like
Thank you,
we
thank
talked
you, sir.
about, thank you, Sam. Thank you, Sam. Yeah, we talked about market inefficiencies and all. So basically, how to find out the subtle difference between a value buy and a value trap, right? Because we are in an era of too much noise, right? So what is appearing cheap to us may be optically cheap, right? So would like to know your view on that front also.
Yeah, so that can only be known whether it's a value trap or a value buy can only be known in the future, right? When you're looking now, obviously, if you're evaluating, you think that it is compelling enough, and that's why you are investing. But I will give you a few pointers. At least that is how I think about it. So first is that we should, as I said, we should be thinking about the business and understand whether it is a business we can understand. That's one, right? And if we can, then we should be okay to take a position. Now, the position size will depend on how comfortable you are. The second thing, very important, most important in my mind in Indian context, is the management. You need to understand and evaluate the management. And this is subjective, as I was saying earlier. So you cannot say with any confidence whether or at least you cannot say with any precision. You can be a lot more confident about it, but the precision is lacking of how good a management is. All you can say is that I think, like, how I was giving example of Samit Ghosh or Nirmal Jain. Now, what I said was very, very subjective, right? I cannot say it's 100 versus 90 versus 80. All I can say is, no, I believe that the management will do the right thing. Now, whether if they don't do it for 1 quarter or 2 quarter, is my confidence shaken? Maybe, maybe not. But it depends on what actions they take when the stock price is down versus when the stock price is up. So I think management is very important. And the third thing is how are they allocating capital, right? And that's part of management, but also part of opportunities. You see so many companies who will talk about, they will expand into this, that, and the other, and not really think about is that a value addition to the company and to the shareholders. So most companies are talking about becoming bigger rather than talking about adding more value to their shareholders. And of course, the most important thing after all this is the price. And a company could be a value buy at one price and a value trap at another price, right? Because if you buy something very expensive, it is very likely that the price doesn't move, even though the business improves a lot. And one may say it's a value trap. And again, value here, I'm defining loosely, right? I'm not defining it by the price to book or price to earnings. It could be defining it as how much returns I can expect from the company, which is how I think about value, right? So I think if one understands the business well, it is very likely, and the management and the incentives well, it is very likely that you will be able to understand if things are going in a positive direction or a negative direction. And that is how you can assess if it is a value buy or a value trap, by looking at how the business is performing on a quarterly basis, how things are moving, and how the management is behaving. I think those are the two main things: business performance and management performance.
Right, sir. So think invest. You can unmute and ask your question.
Hi, hello everyone. Hello, sir. I joined this discussion late, so I'm not quite sure if this query has been addressed, but I'm keeping it, I'm in front of you. So, actually, I think for retail investors, choosing a right business is indeed a tricky thing and most critical part as well. So, valuation is the second part, according to me. So, I just want to know if with your experience, if you can share the basic steps by which one can shortlist a business just to keep in watch list. So I'm sure when price goes down, one can invest with the, some type of intellect or patience, right? So shortlisting a business for a common man for normal returns, not exceptional returns for maybe 14%, 12% per year. What would be the right basic steps? Yeah, this is my question.
Yeah, thanks. So actually, what I would say is the difference between a successful investor and an unsuccessful investor is all about the patience and discipline, right? And so, whether it is a professional investor or a person who is doing it on the side, the most important thing in my mind is to understand the business. And many people say, "Oh, I missed. Call it X, whatever X is, right? Let's say Reliance, or call it anything. It doesn't really matter." But if you missed it, that means that you understood it in the first place. And I think the biggest mistake I see people make in investing is they invest into businesses which they don't understand. And so my recommendation always to people is that if you don't understand a business, it is not an opportunity that you should even consider, right? And the implication of your question, and maybe I'm misinterpreting it, but the implication is I do not understand the business as well. But because the price has come down 20%, I think, and because it was in my watch list, maybe I should buy. And my suggestion in those situations is, unless you think a business is something that you understand reasonably well, I would not even consider that as an opportunity or something even in your watch list. Because suppose it has come down 20% and now you buy it and it falls another 20%. What will you do? Right? Will you now buy more? Will you sell it out, or will you be patient? And suppose it falls another 20% from there. What will you do? So, my question is, if you're looking at buying anything, you should first ask yourself, how will I behave when things go up 20% and things go down 20%? And if you don't know, that means that you don't understand the business and you don't understand the valuations and you don't understand the management. So then I would recommend to anybody that they should do more work. Because if you do more work, you will build that conviction in some businesses where you will say, you know what, if it falls 20%, maybe it becomes even more compelling, assuming nothing has changed. It is possible that the data points have changed, the business is deteriorating, and therefore you don't want to buy, which is perfectly reasonable if the facts change, right? But many times, if the facts don't change, nothing has changed other than the price. And in that case, what is it that you will do? And why 20% or 30%? You can pick whatever number you choose. But my point is, one should have the ability of assessing their behavior, or at least thinking today and saying, what will they do? And the more you can think that way, the more you will be able to figure out if you understand a particular opportunity. And I always say that if you don't understand an opportunity, well, it is not an opportunity for you. It may be for somebody else. And there's so many segments of the investing area that I think I don't understand. But that does not make me not a professional investor. All I need to do is to find a few areas that I understand well and be around them. As Buffett has said, circle of competence, right? I don't want to worry about what is happening to so many other new businesses or businesses that have been there for a while, but which I don't feel I have a good understanding of. And that also doesn't mean that I should not keep trying. So I will keep trying to understand those businesses, but those are not the businesses which are in my current opportunity set. And at least that is how I think.
Thank you so much, sir. Completely understand the question.
Thank you. Sir, like
Thank you.
when it comes to approach, which one you prefer, top-down approach or bottoms up? And any sectors of in flavor which you see can do good in next say 3 to 5 years or maybe 2 3 years, apart from financials which we already discussed.
Yeah, so I think, at least for me, what I try to do is to be aware of top down, but I'm always investing bottom up, right? Because as people have said, and I think to understand the top down and why top down doesn't work as well for most people, I think one can read about Howard Marks and how he talks about things, right? Which is, if you want to do top down, not only do you need to be right, but then you need to be right than the broader market. And it's extremely hard to do that. But you should definitely be aware of the macro. You should be aware of what is happening in the world, what is happening in India, what are the possible challenges, but also what are the possible opportunities. So to answer your question, I think I invest bottom up, but I am aware top down, and just being aware of what is doing well, what is not doing well, why, and so on, right? Now, to your second question of what sectors may do well, I think one has to look, and again, being aware of top down, one can say that at least the world doesn't look like a place where there is a lot of growth happening in 23, given the headwinds that we see. And so sectors that are very much export focused may have some challenges, right? That doesn't mean that every single company in each of those sectors will have challenges, but it does mean that one should be demanding more from those companies if one is investing in, right? And so I would suggest to the audience that we have today that they should be thinking about companies that are much more domestically focused, at least in the next year or so. That doesn't mean that we will not change our view, tomorrow if something changes. But I'm just saying today, given the fact that Europe is going to have challenges with the high energy cost, and US possibly is looking at a recession. May not be a deep one, but maybe there may be some recession or slowness of growth. Any export-oriented companies may suffer. But of course, then the second level comes in. What if some other companies or other countries don't export as much, and therefore India may be able to export more? So yes, all those things come into the consideration. But broadly, that is what I would say. And so if you then look at domestically focused companies or domestically focused sectors, a few interesting ones other than financials could be real estate. Real estate has been in the doldrums for almost a decade, right? And in the last year or two, it has started picking up. So one could look at that. One could look at companies where they will benefit from the capital expenditure and the new capex cycle that is coming in India because of the credit cycle as well. It could also be some of the new industries that are coming in India, and that may create a lot of demand for those industries, or things like because there is a China plus one strategy that is going on, and that may create a lot of demand for India. But look,
Sir, I think we lost you. We couldn't hear you. Is it with me only or Vajpayee ji?
No, sir, we are also facing the same issue.
sorry, what
Rajiv
is
sir,
there a problem?
yeah, we couldn't hear what you said in last 30 seconds. It was like we are not able to hear that.
Oh, okay. So what I was saying was, I don't know till where did you hear? Do you want me to respond again to the question or?
Yeah, sir, you were telling about the real estate and it was in doldrums lately. So, yeah, up till then we
Okay,
heard
I
you.
see. Okay, got it. So what I was saying was real estate has been in doldrums for almost a decade, and in the last few years it has picked up. So I would say that could be an area to look at. But again, real estate has its own challenges. Things can be opaque. So one has to be looking at all these things with a lot of salt, right? One should not be just saying, okay, real estate, this will do well. No, I think it has to be the investment process has to be company by company, right? But what I was saying was one has to look, or one should, if you look at top down, you should say, listen, domestic is going to do much better than exports, at least in the short term. So maybe there may be more opportunities there. But once you do that, when you're looking at companies, the company analysis has to be thorough, and it cannot be just based on, okay, real estate will do well, so let's just invest in the top three. I would not do that. I don't do that, at least. Whenever I'm investing, I am investing bottom up. So I will understand the company. And then if it also aligns with my broader top down perspective, then that could be an interesting opportunity. Another thing, another area that I feel could be very interesting is around the whole capital expenditure. And because of the new capex cycle, infrastructure, new capacity building, all of that could be interesting. Now, again, infrastructure companies have really, really suffered in the last, let's say, decade plus. And so the question is, why will it change? And if you have a feeling that it could change, that could be another interesting area. On the other hand, if you feel it may not change, then obviously stay as far away, because at least historically they haven't done as well. So I think one has to have a top down view is okay, but frankly, it is not worth a lot in my mind. I always try to invest bottom up. And if it aligns with my top down view, then it makes the thesis more compelling. But that is not how I develop the thesis.
Correct. So, Rajesh sir, like these days we are seeing I mean, basically the market share is going to the more to the organized players from the unorganized space. So, do you see this as a mega trend across industries?
Absolutely. I think it's definitely a mega trend, which is that formalization of the economy is being seen everywhere, right? Be it the tax receipts that we see to some of the companies that are there in the sector continuing to grow and take market share. And frankly, market share was never really something that we could have even understood, because it was not even considered as a market because of the informal sector, right? But I would see that this trend where more and more formalization is coming in, and companies who are playing by the rules are likely to continue to do well. I think that is a mega trend. And all of the things, be it the GST, be it the how we can now create challans automatically, everything is forcing the companies to become much more formalized and actually bring things on the books and in view of the public. And I think that as a trend is not only going to give much further boost to the companies that are playing by the books, but I think will actually give them better valuations also, because things that are up and out in the open can help the investors understand if the companies are worth their money, right? And that I think is absolutely critical. And I think that is one thing which most people don't realize about India, that India had these this economy, the unformalized economy, which people have not really figured out how big that is. And we think it was quite big. We think that as that moves to the formal economy, that will further drive the growth of the country in terms of the GDP and in terms of the opportunities from a consumption perspective.
Right, sir. So, sir, when we talk about micro and small cap space, so we see a huge opportunity size. But again, that comes with a caveat that there is too much volatility and very less information available. So, what could be the ideal approach to go about studying those companies? And when it comes to, say, scuttlebutt and all, so what should be the pointers one need to look at?
Yeah, so I think in micro, I am not so sure, but in the small cap space, or maybe even in the micro cap space, what I have realized over time is that the information that is available out in the public domain has become pretty significant, right? So one could decide that you want to focus on companies where there's enough information. Now, I think. For example, I was talking to somebody, somebody on the sales side, and they were saying, "Oh, you know what? When you are in India, I can take you to Reliance and meet them." And I'm like, what will I do spending some time on Reliance? The information is perfect. Everybody knows whatever there is to be known about Reliance. And for me to spend any time on Reliance will not add any value to my thesis on Reliance because I think I am at a disadvantage, right? So going back to small and micro cap, one of the things that can give an investor an advantage is where there is information that is not incorporated into the price, right? And that can happen in areas which are not well covered. And so that is where small and micro cap may have a lot of opportunities for investors. But at the same time, you need to balance things where it is not accounted for in the investors versus it is not even accounted for in your own thesis, right? And so if you don't understand something, and you may want to understand it through scuttlebutt, but you may want to understand it by doing a lot of searches on the net. And frankly, if a company is a reasonably sized company, I would say that most of the information can be found on the internet. Now, some people go and talk to the dealers and talk to the consumers and all of that, and that's great. We don't spend a lot of time doing that unless we feel that there are companies where we have a very strong view and there is not a lot of information. And in the past we have done that sometimes, but most of the time now we find that with the conference calls, and if you just go through like 5 years of conference calls, you can understand the company very, very well, right? So we feel that if you are able to spend time understanding what smart analysts are asking the company and evaluating that could be a lot more valuable, because that gives you not a perspective on what is happening today, but what has happened in the past and how the management has reacted to those things, both the management and the business. And so to us, at least, that is even more valuable than the typical scuttlebutt that Peter Lynch and others used to talk about way back when.
Right. So, basically, I mean, we kind of already discussed also, but selling comes with a regret, right? So, is there any set rules for selling, or valuation is one you already talked about? Is there anything else I mean, say technicals and all for sell decisions?
Yeah, no, so it's a very interesting question you ask. I always used to be very skeptical of technicals. I still am, but I want to keep learning about technicals, not because I will necessarily use it, but it's helpful to understand how people use it. And so right now we don't incorporate technicals too much into our either buying or selling. It is something that we know people use, and it is something that we want to be aware of. And if there is any good strategy or any good uh, approach that the participants have used, which they think has been helpful to them, I would be very open to learning about that. But to give you the answer, we don't use technicals, but we are always open to learning new ways of improving our approach.
Right, fine enough, sir. So, guys, if you have any questions from Rajiv, sir, you can directly send in a speaker request, or you can type in the comments. Rajiv, sir, how good we are on time?
I'm happy to spend some more time if there are questions.
Right, right. So basically, when see, when you started after a break of say 10 years, right? So you got a trigger that yes, but again, who were your investing idols and what literature and case studies in the past helped you grow as a good investor over a period of time?
Yeah, so I first of all I would say, Warren Buffett and Charlie Munger are wonderful role models for most investors. I mean, I have benefited immensely from them, and I think not just in investing, but even in my life, right? How to think, how to behave, how to react to other things. I think I always say that knowing and coming to know Warren and Charlie has changed my life trajectory for the better, right? And in a few different ways. One, at least in my mindset, way back when, I used to think that people who make money are people who are not necessarily upright and straightforward and they're doing X and Y and all that. But, coming to know them, I realized no, there are many easy ways of making money. And the easy way is to do always the right thing, right? And that is what I try to do. And, you know, the more you read about Warren and Charlie, and, now there's so much material more available, right? Warren has done these lunches, the charity lunches, and so you can hear some of the people who have attended those and how they have found Warren and Charlie. And for the last, let's say, 5, 6 years, I have been a regular at Berkshire annual meeting, and so I can see for myself, and I can see the type of people that they attract, and I can see what type of people they are. So I think just having and being in the right ecosystem, I think, is so critical. And one of the reasons I'm doing this talk today is because I want to keep building my ecosystem, right? And the ecosystem of working with good people. Because to me, what is most important is to know people who I feel are good people, because that will move me in the right direction. And so I would say, if one of the things you want to take away from this talk today, it is not just about investing. It is about how to live one's life and how to always do the right thing. Because over time, what you do will influence what you become. And what you become will influence what you do. And so it's a very good feedback loop, positive feedback loop, that all of us should try to learn from and benefit from. And then in terms of the literature, if people have not read, unfortunately, there is this feeling that if something is freely available, it is not worth as much. But what I'm going to tell you is freely available, but I don't know how many people have read it. Just please go and read all the Berkshire annual letters that Buffett has written. It is freely available on the website. And I think read it in a chronological order, starting from the earliest letters to the most recent letter. And one thing you will find first that those are best, maybe even better than an MBA. It doesn't take much time, but it is just so much of life lessons and investing lessons in that. But the second thing is that Buffett repeats a lot. So after some time, you can start moving through those letters very fast. And frankly, there are only so many good ideas. So if Buffett is repeating, it is because those are the ideas that have worked well for him. The second thing I would say, if people have not read, please do buy. It's not a cheap book, but Poor Charlie's Almanac, right? And that talks about Charlie Munger and how some of the talks he has given, and the psychological biases that he talks about. And I think those are really, really helpful to think about how to behave in situations, how to react to different influences. And maybe I will make a provocative statement here, right? And that is that the whole crypto world has been on fire for the first, let's say, 6, 7 years, and in the last year or so, it has come down. And I was very confused about crypto and what exactly is going on, right? And once this question was obviously posed to Munger and Buffett, and Munger has said it is rat poison, right? And rat poison twice or whatever, or squared, right? And so once you hear that, you say, well, it's easy, it's a pass, right? And this is something which is a pass for me for the last 5 years that I have at least been tracking it to some extent. And so the point is, sometimes you can simplify life by just removing a lot of things from your life which you think may not help. And that is just another great example of why understanding from other people who have figured it out can be so beneficial.
All right. So before coming to Ron and Vishwanath, I have one question. Like you talked about Howard Marks. So, if we talk about Howard Marks and don't discuss cycles, that would be, I mean, we should. So, what all market cycles are important for a, I mean, simple investor as a retail investor too? And like, say, if we talked about a credit cycle, so how we can gauge where we are in the cycle so as to place ourselves better?
Yeah, no, I think that's a wonderful question. And I will tell you that because I think one of the reasons I'm bullish on India and I'm so bullish on Indian equities is because of the credit cycle, right? I think if we look at the credit cycle, it has been depressed in India for almost a decade now, right? From 2012, at least the public sector banks have been really struggling. And finally, in the 22, financial year 22 and now 23, we are starting to see that the public sector banks' balance sheet have healed and they are starting to grow the credit. And I think one of the challenges in an economy like India is that we don't have enough credit for what the economy needs. And so as the credit cycle improves, we think that that will drive a whole new slew of growth opportunities in India. And that is one of the reasons why I think I'm so bullish on financials. Right? So I do think that
Sir,
credit
again,
cycle in India is
speaking.
actually is breaking again.
It's fine. Now it's clear.
It's, yeah, I have a feeling that maybe the internet here is a little unstable.
Oh,
And I'm sitting in US, so the fact that it is unstable just makes me unhappy about it, but can't do much about it. So, um,
um,
I, are you able to hear me? All right.
all right.
Yeah, yeah, loud and clear.
Okay, fantastic. Okay, so I don't know again where it became unclear. Do you want me to answer the whole
So the
thing
whole thing
again?
again.
No, no, it was you were talking about the credit cycle. Yeah.
Okay. Yeah. So I think I am quite bullish on the credit cycle in India. And I think to an extent, this credit cycle in India will offset some of the headwinds that we are seeing in the macro economy the world over, right? So if a credit cycle was working and the macro economy the world over was working, I think it will be even faster growth. But just because one thing is counteracting with another thing, it may have some challenges. But overall, I feel very bullish on India because of many things that have been cleaned up. The asset quality has been cleaned up. The balance sheets of Indian companies are in very good shape now, and so they are in a position to start doing capital expenditure and growing the capacity. India is positioned very well from a geopolitics perspective, right? The fact that uh, some of the countries which were the engines of world growth are struggling to have the same level of trust as they had in the past should mean that much more opportunities should come to India over time. I think the fact that India has positioned itself more positively with other countries in the world, I think is all good. Now, coming back to the cycle question, though, I do think that the cycle in some of the other countries, especially the big countries out there, may be going in the reverse direction, right? If you look at the market cap to GDP in India, it is around, let's say, around 106, 110% versus in US. After the fall, even it's around 140%, right? So clearly, some countries have higher valuations, even when the cycle is turning for the negative. So I think one has to be aware of the cycle. And again, I must emphasize that I give all these data points or all these my views on things, but that is not how I invest. That is something that I keep in my mind as I'm thinking of investing, right? But the investing has to be bottoms up. Investing has to be based on the companies that I understand, which I think has good valuations and good growth opportunities, so that it can give me good returns, right? And so I do think from a cycle perspective, though, that things can be reasonably good in India and may not be so good in some of the bigger countries out there.
Great, great. Fair enough. So, you can quickly unmute and ask your question.
Hi, can I go ahead?
Yes, sir, we have. Ron, go ahead.
Yeah, one by one, you guys can go.
All right. Thank you, Prince, for the opportunity. Rajiv sir, a big fan of you, and just wanted to understand and pick your brains on this point of you did speak about circle of competence, and I somewhere have married this point with Monish Pabrai's cloning and circle of competence, and I've been investing following these two approaches. But how do you handle a scenario where what I'm not comfortable is something which is not in my circle of competence, and I choose not to clone anything, even though it's some of the best investors have invested, because I don't understand that. And case in point here is, let's say, specialty chemicals. I don't have a chemical background. I don't understand how the business works, so I've chosen not to invest. But how do you handle the regret bit where you see that you had written down notes about a company at some price and it has gone up 2x 3x, but you chose not to invest because it was not in your circle of competence? So yeah, I mean, long question, but if you can just throw some of your thoughts on this.
That's again a very good question, because we see a lot more opportunities than we understand, right? All of us, and specialty chemicals and your point of view,
Sir, we lost you again.
I think let's just wait. I think it should connect in some
In
time.
some time. It's fine now.
Hello.
Yes, sir, we can hear you now.
Hello.
Yeah,
Hello.
Rajiv sir, you can speak now.
Okay, great. All right. So, I was saying that specialty chemicals is something I've always been interested in, and I also had the same issue, which is I don't understand it well enough. But to answer your question, at least the way I think of it, I think that specialty chemicals is not an opportunity for me because it is not something that I understand, right? That doesn't mean that I will never invest in it. One of the things I also find, and that is a paradox, or that is quite in conflict with how I think of things, is the fact that unless you invest in something, you don't understand it well, right? So, suppose specialty chemicals, you say, listen, I don't understand it, so I should not invest. But one of the possibilities is that rather than investing 5%, you invest 0.5%, right? A very small proportion of your portfolio into into a sector or a company which you feel is interesting, but you don't understand it that well. And what I think that does is that it forces you to keep learning about that company and about that sector. And so taking a very small position, maybe 0.5% is also too big, 0.1% or 0.05%, whatever sort of gives you the comfort. But taking a very small position and then continuing to learn about the company and other companies in that particular sector can slowly build your knowledge. And what is one interesting thing about Buffett? He bought one share each of many of the companies that he just wanted to track, just because so that he will get all the information about those companies and through that be able to learn about them. And even though Buffett always says, listen, only focus on companies which are in your circle of competence, many people forget that Buffett has been a genius in terms of how he has expanded his circle of competence, right? So the game is not just to stay in your circle of competence, but also to keep expanding it. And one of the ways of expanding, at least that I find useful, is to take a very small position in a company that is of interest to me and then follow it and learn about it and about the sector and gradually get to a stage where you feel you know something about it so that you can take a bigger position. I hope that was helpful.
Thank you, sir. Indeed, it's an amazing perspective. And I was just recalling one of the interviews which Warren Buffett had done post his long meeting with Bill Gates. And he said he came back and he just bought 100 shares of Microsoft just to track. So I was just recalling basis your response. I just recalled that moment. So thank you so much.
Sure.
Thank you, Ron. So, Vishwanath, you still there, or shall we move on?
Yeah, am I audible?
Yeah, fine.
Thank you, Mr. Rajeev, for the very useful speech. So I just have one question. Being a bottom-up stock picker, so can I know what is your average holding period for a stock? And this is the first question. The second question is, if and when you decide to exit a stock, what are the key reasons for you to exit? Like, is it the valuations predominantly, or is your thesis has placed out? So these are my two questions. Thank you.
Right. So I think I don't evaluate my holding period regularly, but when I did, and I did it for my personal portfolio over a 7-year period, which is from
Okay.
2014 to 2020.
Hello, I'm not able to listen. Hello.
Um, are you
Are you
able to
able
listen
to
to me
listen to
now?
me now?
I think some issue with Vishwanath. Rajiv, we can hear you clearly. So in case he misses, he can listen to the recording or maybe get into
Okay.
a
All right.
network area.
Sure. Okay. So I think in terms of my holding period, what I was saying was I don't track it regularly, but between 2014 to 2020, when I was doing analysis on my own personal portfolio, I found that my turnover was around 25%, which basically meant that I was having a holding period of 4 years, right? But that doesn't mean that I hold every stock for 4 years, obviously. And it doesn't mean that that is what I'm trying to achieve. What I am trying to achieve is to have positions in my portfolio which I think will do well, right? And now this goes to the second question of his, which was, when do you sell? And so we sell, and I think you might have heard this from many other investors, so we are no different. But we sell when we think our thesis have played out, in the sense that we think that the expected returns from here on may not be that compelling vis-a-vis other opportunities that we see in the portfolio. We will sell if we think we are wrong. Our thesis was wrong, and the company has not performed as expected, and the management has not performed as expected. That could be another reason why we will sell. And the third reason is that we don't have enough cash in the portfolio and we are looking to sell something, right? And when we are looking to sell something, even though this may look like an interesting opportunity, but because the second or the opportunity in front of us is a lot more compelling, we would rather allocate our capital there rather than into what we have. So it's really a question of what we have in front of us versus what is it in the portfolio.
Right. So what your view on smart money movement and how tracking that can help us with our investment if it helps?
Yeah, so I don't track it. I don't know how it helps. And if there are any people on the call who have found that useful, please do let me know. But I don't track it.
Right. So, thank you so much, Rajiv sir. We are almost done with all the questions, and there were many smart questions from the attendees as well. So, in the end, I would like you to tell our audiences about the thought process in Doordarshi Fund, and if anybody wants to get in touch, how they can benefit. Of course, a holistic view, no sort of sales pitch, I know. But if you like to talk about, you are free to do that, please.
Yeah, no. So Dudarshi India Fund that we have is a US based fund. So only investors who are NRIs who are non-Indians can invest in the fund, and it is based out of Delaware. And our strategy is a long-term, long-only focused fund, right? So we want to look at companies that we think can do well, and because we have that long-term orientation, we want to welcome only investors who feel that they have a similar orientation to us. Many times we get investors who may not be well aligned, and in those cases, we encourage them to find other people or other fund managers who might be better aligned with them. Of course, if anybody on the call wants to know more about what we do, I would encourage them to go to our website. It is something that is also available on my Twitter profile. It is dodarshiadvisors.com. You will find a lot of information there. And I think the other thing that we do not talk much about is that I also present on this website called Sum Zero. It's a website where different buy side analysts give their stock picks, right? And that is where I think Sam might have found about IIFL and Ujjivan and all of that. But the idea is for us to create a track record, and many of those theses are available on our website for people who visit that. So feel free to go and have a look at that, because it will give you a sense of how we think. And I think ultimately how we think is what will determine what we will end up achieving. Apart from that, people can go to my LinkedIn profile, search for Rajeev Agarwal Dudarshi India Fund, and you will find us. Or on Twitter, obviously we are doing on Twitter, so people can look at my profile with it, which is at Rajeev_AGR on Twitter. And feel free to reach out to me if there are any comments, and if there are things which what I have said you disagree with, feel free to reach out definitely, because I do want to know what I'm missing, what you're finding useful. The one thing I do know is that there are many ways of making money. What I have laid out is just one way, and so to the extent that people feel others are working, like smart money movement or technicals or whatever, happy to learn more about it, because I think in investing, the only thing we can all say is that we are all learners and we are all trying to become better investors and better people in our life, right? And to that extent, that is one of the reasons why I really enjoy this industry, because you need a lot of curiosity, you need a lot of willingness to learn from others and to keep becoming better. So that's why it's a lot of fun.
So thank you so much, and thanks for doing. I mean, I hope we did justice to your time, and it was a very interactive and knowledgeable session. And the session is recorded, so it will be available on my Twitter handle, as well as I'll be putting the audio podcast over my YouTube channel so that it can be revisited at a later point in time. Last advice.
Fantastic.
Any advice which you want to give to the early investors, or maybe the COVID investors per se?
No, so I would say, what, don't be in too much of a hurry. Too many investors want to make all the money in the next 6 months or next 1 year or next 2 years. I think this is a long game. And so if you treat it as a long game, so that's one advice. The second thing is to always remember that when we are investing when we are buying or selling a share, we should think of not buying or selling a share, but buying or selling a business, right? And so just as a business takes a long time to succeed, so will investing. And so if you have that patience and the long term perspective on things, you're very likely to do a lot better. Because I think, as was mentioned on the call earlier, there's a lot of noise, right? But there's a lot of noise in the short term. If you expand your horizon to a few years out, then the noise becomes a lot less. And so the willingness to think long term and reduce the noise and focus on what is essential is what makes investing so remunerative and so interesting in terms of growth for the person. And I hope that many of you will be able to take advantage of investing, because I think it's one way of learning a lot and at the same time making some money. So I wish everybody on the call a very rewarding investing, whether it's full time, part time, and a lot of fun while you are learning new stuff in your journey. Thank you.
Great, sir. So surely would like to have some session down the line, and we will keep on learning from your experience and all. So thank you guys for attending and listening patiently to the insights shared by Rajeev sir. And please check out the handle and the website just told, so that you can get a touch and feel. And if you're liking our work, please check out our handles. And if you feel like we can offer some kind of value, do follow us so that we can connect in future also. And thank you so much. Thanks. Keep coming to our spaces. There are many good spaces in pipeline for December. So I'll be posting those shortly. And if you have any kind of feedback, positive, negative, as Rajiv sir said, please do tag us with that, or maybe you can DM, so that obviously it's a platform where we all learn from each other, and there is no one thing right for all. So with this, I take your leave. Thank you so much, Rajiv sir.
Sure, it's wonderful. Thanks a lot, Prince, for organizing this.
Thank you, sir. Good night, guys.